This video might just change the way you earn from your investments. Tired of waiting 3 months for a small dividend check while your expenses hit every single week? It doesn't have to be that way. Today we're flipping the script. What if you could get paid every week without investing a single dollar more? It's possible, thanks to 12 powerful dividend assets working together to deliver consistent weekly income. In this video, we're revealing a game-changing strategy that flips traditional dividend investing on its head. We've built a portfolio of 12 high-yield assets that work together to pay you $250 every week from a $100,000 investment. That's nearly $1,000 a month in pure cash flow, without ever touching your principal. Stick around, because we're breaking down this weekly income blueprint, asset by asset, and showing you how to turn your portfolio into a predictable paycheck. Welcome to Alpha Investors Channel, where we don't just chase dividends, we engineer income using this blueprint. First, let's talk about the blueprint behind this weekly income strategy. So how did we pick these 12 assets? Most people just scroll through a list of top yields and grab whatever shines the brightest. But that's how you end up with some flashy monthly payer that collapses faster than your motivation at 5 a.m. We're doing it smarter. Our approach is built around 3 key criteria. 1. Real meaningful yield. Not this 4% annually, paid monthly so it feels generous nonsense. We want yield that actually moves the needle, enough to matter if you're serious about building weekly cash flow. 2. Diversification. We've handpicked 12 assets across multiple sectors: ETFs, REITs, BDCs, and mREITs. Each brings something unique to the table. That way, if one sector stumbles, your entire plan doesn't fall apart. 3. Stability. We don't touch dividend traps or ticking time bombs. These are sustainable income machines, built to last, not just impress on paper. Here's how it works. We divide the month into 4 weeks and group the 12 assets based on their payout dates. That means 3 assets per week, each dropping cash into your account like clockwork. Think of it like a meal plan for your wallet. Balanced, intentional. Week 1, diversified ETFs to set the tone. Week 2, REITs for steady real estate income. Week 3, BDCs to crank up the yield. Week 4, mREITs to finish strong with high-octane cash flow. Ready to turn your portfolio into a weekly paycheck machine? Week 1 is all about laying the foundation with ETFs. Why? Because ETFs are like the Swiss Army knives of investing. One ticker, instant diversification. You're not betting on a single company, you're spreading risk across dozens, even hundreds. That's how we kick off this weekly dividend engine, stable, diversified, and built to yield. First up, Div. The Global X Super Dividend US ETF. This fund focuses on high-yield US companies and spreads your risk across 50 names. Most of them fly under the radar, but they consistently cut fat checks. The dividend yield? A solid 7.07%. Not bad for something this diversified. Next, JEPI, the JP Morgan Equity Premium Income ETF. This isn't your typical S&P 500 clone. JEPI plays smart by selling covered calls, trading a little upside for a lot more income. It's like renting out your future stock gains. The result? A juicy 8.81% yield, managed by JP Morgan's elite team, not Reddit traders. Then there's SDIV, the Global X Super Dividend ETF. This one's the wild card. It pulls in high-yield names from around the world with a tilt towards riskier sectors. It's perfect for the adventurous part of your portfolio. The yield? A massive 11.26%. So week 1 is locked and loaded. A trio of dividend-paying ETFs, domestic, premium income, and global. Together, they deliver a rock-solid launch to your weekly income stream. Now, it's time to bring out the big guns. Week 2 is all about predictable, durable, rock-solid cash flow, and nothing delivers that better than REITs. These companies exist for one reason: to own income-generating properties and pass that income directly to investors. Think of them as the landlords of the stock market, except you're the one collecting the rent. First up, O, also known as Realty Income, or as dividend investors like to call it, the Monthly Dividend Company. This REIT owns thousands of commercial properties across the US. leased to blue-chip tenants like Walgreens and 7-Eleven. It's built for consistency and has paid monthly dividends for decades. The current yield? A steady 5.64%. It's not flashy, but it's about as close as you'll get to royalty in real estate. Next, EPR Properties. This REIT focuses on experiential real estate. Movie theaters, golf complexes, ski resorts. It's more cyclical than O, but it comes with more upside. When the economy's buzzing, EPR prints cash, and with a yield of 7.13%, it pays you well to invest in fun. Then there's APLE, Apple Hospitality REIT. This one's all about hotels, Hilton, Marriott, and other top-tier brands. It's a pure play on US travel demand, and unlike malls or office buildings, hotels are booming right now. APLE offers a generous 8.15% yield, paid monthly like clockwork. So week 2 stacks up as a REIT trifecta: O for stability, EPR for entertainment upside, APLE for travel-driven growth. Together, they bring balance, resilience, and reliable real estate income to your portfolio. You don't need to own the buildings. Just sit back and cash the checks. But if you thought REITs were generous, just wait till you meet the cash machines in week 3. Week 3 is where you stop sipping income and start chugging it. We're unleashing the BDCs, business development companies. These things don't mess around. Forget Fortune 500s. BDCs lend money to the scrappy underdogs of the business world. Private companies that are too small for Wall Street's radar, but hungry to grow. In return, they pay fat interest, and BDCs pass that cash straight to you. Translation? More income, less waiting. First up, Main Street Capital. The golden child of BDCs. It's steady, disciplined, and surprisingly classy for how much income it throws off. Main invests in profitable, lower-middle market businesses and manages risk like a pro. That's why it's built a loyal cult following. Yield? A solid 5.70%, but don't underestimate it. Main also dishes out the occasional bonus dividend like a rich uncle at Christmas. Next, paycheck, Prospect Capital. This one's the wild card. It takes on higher risk, higher reward deals. Think leveraged lending and complex structures. That's exactly why the yield clocks in at a massive 15.13%. It's the adrenaline shot to your portfolio, not for the faint of heart, but a serious income engine when managed wisely. Then we've got HRZN, Horizon Technology Finance. This one lends to venture-backed startups in tech, life sciences, and clean energy. It's like a Silicon Valley banker, except it actually pays you. The yield? A jaw-dropping 18.49%. That's not a typo. That's rocket fuel. So week 3 is all about turning up the heat. These BDCs supercharge your income and inject some serious growth potential into your portfolio. Your weekly paycheck just got a whole lot thicker. But we're not done yet. If you want to see what next-level income looks like, wait until you meet the mREITs. Week 4 isn't just a grand finale. It's the fireworks show. This is where we bring in the wildest income machines on Wall Street. mREITs, Mortgage Real Estate Investment Trusts. These beasts don't own buildings. They own mortgages. They borrow cheap, lend at higher rates, and shovel the difference straight into your pocket. High risk? Definitely. High yield? Absolutely insane. First up, ARR, Armor Residential REIT. It focuses on agency-backed mortgage securities, which puts it on the safer side of the mREIT world. It's still volatile, sure, but ARR knows how to navigate rate swings and keep the payouts flowing. Yield? A hefty 17.49%. This isn't a trickle, it's a flood. Next, EARN, Ellington Residential Mortgage REIT. It's smaller and more nimble, kind of like the special ops of mREITs. Constantly adjusting to market conditions, EARN plays the adaptability game. It can be unpredictable, but it still throws off a massive 17.91% yield. And finally, ORC, Orchid Island Capital. This one is pure high octane. ORC goes big on agency MBS and isn't afraid to use leverage. The result? A mind-melting 20.31% dividend yield. Yes, you heard that right, 20%. So yeah, week 4 doesn't play it safe. By now you're not just getting paid weekly, You're basically collecting a paycheck from Wall Street. Now that the 4-week strategy is locked in, let's run the numbers. We're starting with $100,000, split evenly across all 12 assets. That's $8,333 per holding. These assets are grouped by when they pay, 3 in week 1, 3 in week 2, and so on. You've got a full mix: ETFs, REITs, BDCs, and mREITs, all hand-picked for high yield and solid fundamentals. Yields range from a modest 5.64% with real estate legend O, all the way up to a monster 20.31% with ORC. Every asset plays a role. Some bring consistency, others deliver knockout income. Now here's where it gets interesting. Because each week focuses on a different category, the payouts vary, reflecting the natural trade-off between risk and reward. Week 1. You're pulling in around $188 thanks to diversified ETFs like JEPI and SDIV. Week 2. About $145 rolls in from reliable REITs like EPR and APLE. Nothing flashy, just solid cash flow. Week 3. Things heat up with $273, fueled by the high-yield power of PSEC and HRZN. Week 4. And then boom! $387 drops into your account, courtesy of the mREIT trio, ARR, EARN, and ORC. Add it up, and you're earning around $1,000 per month, or $250 per week, like clockwork. That's $12,000 a year, nearly 12% of your original investment, all through dividends. And the best part? This income doesn't show up once a quarter. It doesn't trickle in twice a year. It hits your account every single week, just like your expenses do. And that's how you flip the script on dividend investing. And just like that, you've got 12 dividend assets working together, paying you every single week like clockwork. No more waiting for quarterly payouts. Markets change fast, and so should your strategy. So stick with us. We'll keep you updated and ahead of the game. Still hungry for more dividend income? Tap the video on your screen and let's take this strategy to the next level together.